If you're getting rejected on million-dollar plus deals, it's probably not because of your deal numbers. You see, most operators assume that when investors say no, it's because the financials weren't strong enough, the collateral wasn't there, or the structure wasn't perfect. But that's not what investors are actually reacting to. I learned this sitting inside institutional capital at BlackRock, seeing deals get rejected or approved before the details even mattered. And once you understand the difference between the retail filter and the institutional filter, you'll immediately see why solid deals keep getting shut down and why changing how you present them can change everything. Here's a mistake that almost everyone makes. They assume that all investors or capital groups evaluate deals the same way, but in reality, they don't. There are really only two types of capital in the world: retail capital and institutional capital. Retail capital is what most operators are familiar with: smaller private investors, hard money lenders, and even some retail banks. That kind of capital is primarily focused on deal upside and care about things like returns, growth, cash on cash, and price per unit. And they rely heavily on things like collateral, credit score, and personal guarantees in order for them to get comfortable. But institutional capital plays a completely different game. These are groups like family offices, pension funds, private equity, and endowments. They are not obsessed with how much money they might make. Instead, they are obsessed with how little money they could lose. What they care about are things like risk, total yield over time, scalability, market positioning, operator capability, and whether what you're doing is something that can actually work repeatedly and systematically and not just be a one-hit wonder. And I've seen this pattern across every asset class. The same operator will get rejected trying to buy a relatively small $3 million deal or business, but successfully get institutional funding for a $50 million platform. And I'll give you a real example from my time at BlackRock. I once saw a deal from an operator who wanted funding to buy a retail mobile carrier business, and on paper, it wasn't a bad business. It had solid cash flow and a straightforward operational business. But from an institutional perspective, it was a single asset, it had limited scalability, and it was very dependent on one specific execution path. So it wasn't a good fit, and the firm ultimately passed. That operator went on to actually raise money from smaller investors, and he ran that business successfully for years. But on the other hand, there was a different operator who also targeted the mobile carrier industry, but he wanted to do a buyout of all parts of their business across the entire continent. And when he approached BlackRock, he wasn't pitching a single retail location. He was pitching a roll-up strategy across the entire mobile carrier retail industry. Multiple locations, centralized operations, clear systems, and a scalable platform. It was the same industry, but completely different filters for each deal. With the second operator, the mobile carrier business suddenly became a much more interesting institutional opportunity, because in reality, most operators don't get rejected because their deals are bad. They get rejected because they're addressing the wrong decision filter. Here's where things get even more counterintuitive. A lot of people think that the solution to making their deal more attractive is to make their pitch safer. So they lead with things like guarantees, putting up collateral, and talking about things like the deal being low risk, a proven model, and having conservative underwriting. And that language works for retail capital, but with institutional capital, it actually does the opposite. You see, when you lead with safety language, you're signaling that the deal is dependent on specific market conditions behaving exactly as expected. And institutions know that the markets don't always behave. And so instead of hearing that this is safe, what they actually hear is, these are the scenarios where this breaks. And you see this mistake everywhere. Fund managers pitching strong returns, business buyers emphasizing nothing can go wrong, real estate operators promising that there is guaranteed cash flow. And all this quietly kills institutional interest. And I want to give you a realistic example of what actually changes a group's response so that you can truly understand this dynamic. So let's imagine that you're pitching a deal, and in your pitch, you spend most of your time talking about IRR, upside, and how great the returns could be. Now, imagine shifting that conversation, where instead of focusing on returns, you frame the investment in terms of downside protection. So you talk about things where your deal fits in their portfolio allocation mandates. You talk about how their capital is protected in worst case scenarios. And you explain what breaks first, what breaks last, and why even in a bad outcome, losses are still controlled or mitigated. Because here is the reality. Framing things in terms of loss prevention is important because wealthy investors have already won the financial game. Generating a little extra return or even doubling their wealth doesn't materially change their lifestyle. But losing capital or cutting their wealth in half absolutely does affect their lifestyle. So retail investors want proof that you can actually grow their money, whereas institutions want the confidence that you won't lose it. And on a psychological level, this concept of loss aversion proves to us that the pain of losing money hurts twice as much as the joy that we feel from actually making it. And once you understand that, then everything about how you present deals starts to change. And this eventually leads to the biggest shift of all, where institutions are really asking one core question, which is, can this operator systematically protect capital and create value at scale? That's it. And that's why deal by deal thinking falls flat. Institutions, they don't want to hear how you found a great deal. They want to hear that you've identified a systematic market opportunity and the reasons why you are uniquely positioned to execute upon it. This is platform thinking, and you see it across industries. For example, there's a commercial real estate investor that I know in the Western US who runs a company that's now publicly traded and is worth over $30 billion. But he didn't get to that by chasing random or individual deals. In his specific case, he started by investing after the 2008 global financial crisis, when fear dominated the real estate market and nobody wanted anything to do with it. But he recognized that assets were systematically underpriced, not because there were actual fundamental flaws with real estate, but because confidence had swung too far into the negative territory. And so he got to work and built systems to acquire, operate, and scale in that environment. After validating the business, he shared his perspective with and recruited a regional executive from a major global bank who was perfectly positioned to take advantage of that macro opportunity. And that's what allowed them to build this big behemoth of a business that they have today. And what that bank executive saw wasn't just a great deal, it was a platform. And I saw this same kind of thinking at BlackRock in completely different sectors. For example, we evaluated opportunities in drone delivery in China long before it was mainstream here in the US, and years before companies like Amazon ever even talked about it publicly. We also looked at companies like Uber early on for the same reason, not because of one specific transaction, but rather because the macro data supported a massive shift in behavior, logistics, and infrastructure. That is systems-focused thinking. And when you understand this filter, then you stop pitching deals and you start presenting platforms. Now, if this is resonating with you, if you're realizing that your rejection problem isn't your deals, but rather your approach, then let's fix it. I'm having calls this week to walk through your specific situation and show you exactly which language in your vocabulary and what other aspects of your pitches are actually hurting your deals. Click the link below this video to book a time and let's chat. Now, here's the big takeaway that I want you to leave with from this video, which is that most operators spend years getting rejected, all because they're using retail language with institutional money. And this isn't an issue of intelligence or capability. It's all about understanding what each type of capital is actually seeking. And once you actually match your presentation to the right decision filter, then rejection becomes the exception rather than the rule. And that's what separates operators that are stuck doing single deals from the ones that are building institutional level platforms and securing millions or even billions of dollars in funding. Now, what you just learned is the difference between hoping that someone funds your deal and understanding how investors actually evaluate it. And that's what we help operators do in Money Raising School. We identify the right investors, how they should be going after them, show them which investors filters they're going up against, and adjust how their deals are presented so that they stop getting rejected for the wrong reasons. And if you want me to look at how you're currently raising money and pitching deals and show you how to raise unlimited capital the right way, then you can book a strategy call using the link below this video. And if you want to see how these same principles apply specifically to real estate deals, then watch the video linked here, which builds directly on what you just learned and teaches you how to raise capital for real estate the right way.